Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Understanding Value at Risk, VaR, for effective risk management. Limitations of value at risk. While value at risk, VaR, is a powerful tool for risk management, it comes with its own set of limitations that can impact its effectiveness in real-world scenarios. Understanding these limitations is crucial for anyone relying on VaR to gauge risk exposure. Assumptions in VaR. VaR calculations are built on several assumptions that can be problematic in practice. Here's what to keep in mind. Normal distribution. Many VaR methods assume that returns follow a normal distribution. But markets are often not normal. Extreme events, known as fat tails, can lead to larger losses than VaR estimates suggest. This means a portfolio could face significant risks that VaR fails to capture. Stable market conditions. VaR typically assumes stable market conditions. However, during periods of high volatility, the assumptions made in the calculation may not hold true. This can lead to misleading results. For instance, using historical data from calmer times might provide an overly optimistic view of risk. Linear relationships. VaR assumes linear relationships between asset prices. This can oversimplify complex interactions in a diverse portfolio. When assets behave in non-linear or unexpected ways, VaR may not accurately reflect potential losses. These assumptions can undermine the reliability of VaR, leaving investors potentially exposed to risks that they thought were minimized. VaR and market conditions. Market conditions play a significant role in the reliability of VaR measures. Here's how. Changing volatility. Market volatility isn't constant. During turbulent times, risk levels can escalate quickly. VaR calculations based on historical data may not account for sudden spikes in volatility. When this happens, the actual losses could far exceed VaR estimates. It's like driving a car and relying on a rear-view mirror. You miss the impending danger ahead. Illiquid markets. In less liquid markets, the price movements can be erratic. VaR doesn't always accommodate this reality. If there are not enough transactions to reflect true price changes, your VaR might not show the full picture. This is particularly concerning for assets that don't trade frequently. Clustering of risks. Markets can experience interconnected risks. A problem in one area can ripple through the system. VaR often evaluates risks in isolation, overlooking these correlations. This can lead to an underestimation of total portfolio risk, especially during economic downturns. Overall, VaR provides valuable insights but relies heavily on its foundational assumptions and market conditions. Without acknowledging these limitations, one could face unexpected challenges in risk management. Are you ready to dig deeper into how to navigate these potential pitfalls in your investment strategy? Applications of value at risk. Value at risk, VaR, is a versatile tool used across various sectors to assess risk and make informed decisions. From investment firms to regulatory bodies, the applications of VaR are significant in shaping how organizations manage their portfolios and comply with industry standards. Use of VaR in portfolio management. Portfolio managers heavily rely on VaR to guide their investment choices. By estimating potential losses, they gain valuable insights into the risks associated with different assets. Here's how VaR comes into play. Risk assessment. Portfolio managers use VaR to quantify the risk associated with their investments. By knowing the maximum expected loss, they can make better decisions about asset allocation. Optimization of returns. Evaluating VaR helps managers determine the trade-offs between risk and return. If one asset has a higher VaR than another, they may choose to limit exposure to that asset while investing more in options that present lower risk. Stress testing. VaR serves as a foundation for stress testing portfolios under extreme market conditions. By simulating various scenarios, portfolio managers can understand how their investments might perform during downturns. Dynamic adjustments. As market conditions change, VaR calculations can be updated to reflect current risks. This dynamic approach enables managers to make timely adjustments, ensuring they remain within their risk tolerance levels. By integrating VaR into their strategies, portfolio managers can align their investment decisions with their risk appetite, ultimately enhancing performance and achieving strategic goals. Regulatory use of VaR. Regulators also utilize VaR to maintain stability in the financial system. They employ it for compliance and assessing systemic risk. Here's a closer look at their approach. Capital requirements. Regulatory bodies often require financial institutions to calculate VaR to determine adequate capital reserves against potential losses. By ensuring firms hold enough capital, regulators mitigate the risks of market shocks. Monitoring systemic risk. VaR helps regulators assess risks across the entire financial industry. By looking at the VaR of multiple firms, they can identify vulnerabilities that may pose systemic threats. This analysis helps in stabilizing financial markets. Guidelines and frameworks. Regulatory frameworks incorporate VaR metrics to promote sound risk management practices among financial institutions. Compliance with these frameworks ensures that organizations maintain transparency and accountability in how they handle risks. Crisis management. During times of financial turmoil, regulators can use VaR to gauge the health of the financial sector. By monitoring risk levels, they can intervene when necessary to prevent broader economic fallout. Ultimately, the regulatory use of VaR contributes to a more resilient financial system by promoting transparency, accountability, and risk-aware practices across the industry. Understanding both portfolio and regulatory applications of VaR equips you with a more comprehensive view of its importance in risk management. Are you ready to explore deeper dimensions of VaR in different sectors? Future of value at risk. As the financial landscape evolves, so too must the tools used for risk assessment. Value at risk, VaR, remains a crucial component, but it's expected to undergo transformations that address emerging challenges and leverage new opportunities. This section delves into the innovations and integrations shaping the future of VaR. Innovations in risk measurement. The future of VaR is poised for advancements through new methodologies and technologies. Here are some of the notable innovations on the horizon. Machine learning. By harnessing vast datasets, machine learning can enhance VaR calculations. Algorithms can identify patterns and correlations in risk factors that traditional models might miss. This means more accurate and adaptable risk assessments. Behavioral finance models. Traditional VaR often overlooks psychological factors in trading decisions. Incorporating behavioral finance can provide a more holistic view of risk, helping investors anticipate potential market shifts caused by human behavior. Real-time data analysis. In today's fast-paced markets, real-time data is crucial. Advanced analytics tools can process streaming data and provide immediate VaR assessments. This helps firms react swiftly to changing conditions. Blockchain technology. The adoption of blockchain can increase the transparency and reliability of data used in VaR calculations. By ensuring data integrity, institutions can make better risk management decisions. These innovations have the potential to refine how VaR measures risk, creating a more responsive and accurate tool for financial professionals. Integration with other risk metrics. VaR doesn't exist in a vacuum. Its effectiveness can multiply when integrated with other risk metrics. Here's how this integration can shape future risk management. Complementary metrics. Combining VaR with metrics like conditional value at risk, CVAR, offers insights into tail risks. While VaR provides a cap on potential losses, CVAR goes further by assessing the risks in extreme scenarios that exceed the VaR threshold. Stress testing. Integrating stress testing results with VaR can prepare firms for unforeseen market events. While VaR estimates normal conditions, stress testing simulates worst-case scenarios. Together, they provide a comprehensive risk assessment framework. Credit risk metrics. For organizations managing both market and credit risks, integrating VaR with credit metrics helps provide a fuller picture. This dual approach enables financial institutions to evaluate the interconnectedness of various risk exposures. Liquidity assessment. Pairing VaR with liquidity risk measures can enhance risk management during volatile periods. Knowing how quickly assets can be converted to cash alongside potential losses helps in making timely decisions. These synergistic approaches turn VaR into a cornerstone of a broader risk management strategy, equipping investors and firms with the tools needed to navigate complex financial environments. By embracing innovations and integrating various risk measures, the future of VaR holds promise for more accurate and dynamic risk assessments. How will you adapt these insights in your risk management practices? Conclusion: understanding value at risk, VaR, is crucial for anyone involved in finance or investing. It not only quantifies potential losses but also helps in making better risk-informed decisions. By utilizing different VaR methods and recognizing its limitations, investors and financial professionals can enhance their risk management strategies. Consider how you might apply VaR to your own investment practices. Are there specific areas where you could benefit from a clearer picture of risk? The insights gained from VaR can drive more confident investment choices. As the financial landscape changes, staying updated on risk assessment tools will be essential. Embrace this knowledge, engage with it, and let it inform your strategies moving forward. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.